Regarding what happened, the synthetic credit portfolio was a strategy to hedge the firm's overall credit exposure, which is our largest risk overall in a stressed credit environment. We were reducing that hedge, but in hindsight, the new strategy was flawed, complex, poorly reviewed, poorly executed, and poorly monitored. The portfolio has proven to be riskier, more volatile, and less effective as an economic hedge than we thought. What have we done? We've had teams from audit, legal, risk, and various control functions, all from corporate, involved in extensive review of what happened. We have more work to do, but it's obvious at this point that there are many errors, sloppiness, and bad judgment. I do remind you that none of this has anything to do with clients. Therefore, the volatility for the rest of this quarter and next quarter or so will be high. It could cost us as much as $1 billion or more. Obviously, we're going to work hard to have that not be a negative at all, but it is risky, and it will be for a couple of quarters.
I'd like to understand why you felt that you needed to add this kind of synthetic credit exposure. Were you not seeing that you had enough exposure through core lending businesses, or what was going on?
Exactly. The original premise of the synthetic credit exposure was to hedge the company in a stressed credit environment. Our largest exposure is credit, across all forms of credit. So we do look at the fat tails of what affects this company. That was the original proposition for this portfolio. In re-hedging the portfolio, I've already said it was a bad strategy. It was barely executed. It became more complex. It was poorly monitored. We obviously don't have to do anything like this at all if we don't want. And, I understand you can ask that question. So I don't want to give you specifics because we've already said we're not going to talk about, the actual positions or anything like that.
And, Jamie, the $1 billion that you referred to in your prepared remarks about of incremental loss potential, is that the max that you envision above and beyond this sort of net $800 million after-tax number?
No, I said the volatility could easily be that. Obviously, it could be worse than that. We're going to manage this for economics. Hopefully, by the end of the year, is the hope that this won't be a significant item for us. We want to maximize the economic value of these positions and not panic or do anything stupid. Therefore, we're willing to bear volatility, and it's life.
And the final question is, how liquid do you view these exposures as being? In other words, if granted you don't want to make economically silly decisions and just cut it off right here, but how easy would it be for you to exit completely and just call it a day and be done with it?
I think I've already said I'm not going to talk about specific risk positions at all.
Okay, I'm not asking for specific positions, just liquidity.
Well, you're getting specific. We will do what we have to do to maximize the shareholder value. We've got staying power, and we're willing to use it.
This was a new strategy that you had decided to exit. Is it possible for you to let us know how new that strategy was?
Not new. I said new, but what I meant is it was the strategy to reduce the credit hedge. So it's kind of a new strategy. It was devised, and as I already said, it was poorly constructed and poorly monitored. All of that, and that took place over the course of the last couple of months.
And the implication, I guess, might have been that there was all this press speculation about certain trading individuals out of London. Were some staff fairly new that came in to execute this new, or some of this new angle, and are those folks no longer in that's been rejiggered, I think you said, right?
No. Nothing new folks, a little bit to do with the articles in the press. So it was somewhat related to that. And it was obviously more than that, but somewhat related to that.
And just in real simple terms, in 6 weeks you lost $2 billion. So as simple as you can explain it, what went wrong?
You already mentioned there are huge moves in the marketplace. These are complex. We made these positions more complex. The strategy was barely executed, barely monitored. I can repeat it 800 times. I'm not going to get into more specifics than that.
And you mentioned...
But Mike, we will be, I already said, at the end of the quarter, we will be talking more about this to satisfy your needs and ours.